startup valuation and investments. Over to you.
Good afternoon, everybody, and I'm very pleased to welcome you to today's session on our masterclass on spotlight on valuing in startups, valuation and structuring, including discussion around Southeast Asia, startup ecosystems and trends. I am going to share my presentation and give everybody a brief introduction on who we are and what you're going to expect today. So I'm joined today by my dear colleagues, Rohit Singh, who is one of our most seasoned trainers and academics in our faculty, and Feriani from our Singapore office. We are very pleased to give you some insights in the topic of valuations and startups, particularly in Southeast Asia. So what you're going to expect today is I'm going to make a brief introduction, and then of course I will hand over to our valuation expert, Mr. Rohit Singh, this is going to then lead to Feriani, who is going to give us a little bit of an overview about the valuation trainings we're offering and the IBF funding schemes attached to it, plus our other M&A trainings where also IBF funding is available. Last but not least, we're very open to your questions, and we will have a little panel and Q&A session where we hope to answer all your related questions to these sessions or our trainings. I might introduce myself. My name is Alexander Bari. I'm the managing director of the Institute, and I will continue with Rohit, who is a seasoned professional in the field of valuation. He's Vice President Investments for Xaria Capital, has worked for very numerous prestigious institutions such like KPMG, Rabobank, and Pricewaterhouse, PwC. And he is, I would say, one of our most experienced valuation faculty members, and he has been a long-standing member of the Institute, providing trainings to hundreds of training participants in this field of valuation, and I'm particularly happy to have him joining this course today. He will also be teaching an IBF funded valuation training course where Feriani is going to tell us more about it at the end of the presentation. Last but not least, of course, my colleague Feriani. She is our representative in Singapore for the Institute for Mergers, Acquisitions and Alliances, and she will guide us through the funding schemes at the end of the presentations. Just a quick overview about the Institute. We consider ourselves to be one of the most leading global think tanks in the field of mergers and acquisitions. Founded in 2004 by Professor Kummer, who is a finance professor. It was initially started as a spin-off of a private university in Vienna, in Austria, in the heart of Europe. And then quickly turned to a great professional education provider with a global network with branch offices in Singapore, New York, Vienna, and Zurich. And we are very proud that we have gathered probably the largest M&A community worldwide already. We have more than 3,000 participants and charter holders who have accomplished our certification trainings from more than 70 countries. So we are truly international professional education provider. We have done trainings with more than 1,400 companies worldwide. Many of them are in the Fortune 500. We have comprised more than 60 hours of faculty videos on our online training platform. We are close to 30,000 registered members on our homepage, and we have more than 100 faculty and M&A experts in our faculty pool, and Rohit is one of our most seasoned faculty members who you're going to experience quite soon. I think one of the main advantages also being a member of the Institute is that we have an extensive library offering with an offer of more than 130,000 books, and we have almost completed 60 on-site and virtual trainings over the past years, and we are going to continue quite a lot in the next years. Just to tell you, I mean, we certainly we offer all sorts of modes of trainings. So whether it's online, self-paced, or virtual, like in this kind of setup we are now, like virtual trainings, or on-site, you can see here one of the last on-site trainings we have done in Singapore. We are hoping to do these kind of on-site trainings again. You can see here a picture of the networking session after one of our certification trainings. So we are scheduled also one on-site training for Singapore in September again. And then we do quite a lot of tailored in-house trainings for teams or companies in case they really want to focus on a specific topic. But enough about the Institute. I'm very happy to hand over now to Rohit Singh to tell us a bit more about the ecosystem of startups and the valuation part of it.
Thanks, Alexander.
Thank you.
I'll just share my screen. Good afternoon, guys. So my name is Rohit, and I'll be taking you through around half an hour to 40 minutes of a course around Southeast Asia startup ecosystem, venture capital funding in this region. And then we'll get down upon understanding how valuation is done in startups in most part of the world, like including developed markets and emerging markets. Because most of the startups you would have seen pre-revenue, no profits, mainly cash burning. So how do we value them? Are they the textbook way of valuation, or there's some other method of doing it? So we'll be seeing various structures also around it. As a background, I'm currently working in venture capital. I'm investing in healthcare technology. It's a global mandate. Specifically, I have mostly invested in Singapore, US and Western Europe area. So my work involves investments, sitting in the board of the companies, growing the company next to 3 to 5 years, and then trying to exit it to provide returns to our LPs. Prior to venture capital, which I have been doing for around 9 years now, I was doing mergers and acquisitions with global investment banks like Rabobank, then KPMG and PwC. So I have worked on the ground, done transactions in Asia, including India, Southeast Asia, and the Western world, that is US and Western Europe. So I have run across large transactions, small transactions, seen the difference in valuation of how do you calculate. Companies having balance sheets, company having no balance sheets and only ideas. How do you measure them? How do you invest in them? And how do you make returns out of them? So we'll be talking about briefly around all those areas and touching upon where IMAA and its course curriculum, which has been designed by experts and veterans in the investments industry, the investment banking industry, on a very practical and to the ground, how the transaction work, how deal works actually, that view rather than theoretical aspects. Now today's session, we have designed it in such a way that the first part would be talking about our home countries, like in Southeast Asia, of the startup ecosystem that we have seen grow in such a big way. We have multiple unicorns going for going for IPOs and SPACs and getting acquired and so on. And then getting down in the second part into how valuation is done and how structuring is done. So we'll kick off with the first part of the story, which is Southeast Asia startup ecosystem and trends. So Southeast Asia, we are a 600 million population country with greater than 6% of GDP on an average. Even though we are 600 million population, we have around 440 million internet users. That's more than 70% of population using internet. Average usage is approximately 4 hours daily, which is much higher than anywhere in the world. because of which the next decade, that is 2020 to 2030, is termed as the internet economy in Southeast Asia. And it is expected that this economy would reach USD 1 trillion gross merchandise value, or GMV, by 2030. When I talk about GMV, we are talking about purchasing capacity or purchasing power of Southeast Asian population through internet. Currently, it's around $174 billion, growing to $363 billion by 2025, and then to $1 trillion by 2030. Now, which are the areas and which are the sectors which will be dominating the increase? They would be e-commerce, then online grocery, and then transport and food, online media would be unlocking the next wave of growth. I would also like to add wealth management and payment platform as the additional drivers going ahead. Now, as we talk about e-commerce, when we talk about e-commerce, we are talking about buying online. When you buy online, here comes the payment gateways. And with the payment gateways, when you start storing the money in the wallets, the startups have started moving and using the money in your wallet into management. So it's a kind of a cascading effect that we have seen, and Southeast Asia will be witnessing over the next 10 years. How a 2030 internet economy will look like? Well, if you look at this graph, Indonesia alone would be 2 times Southeast Asia's GMV today. So what is Southeast Asia's GMV today? It's around $174 billion. So Indonesia alone would be twice of that, or $330 billion GMV, or gross merchandise value, meaning people interacting with the internet and buying products. Vietnam would be 3 times Indonesia's GMV today. So if it is $70 billion, Vietnam is expected to be 3 times that. And Philippines and Thailand could reach 2 times Indonesia's GMV today. And total would be $1 trillion in Southeast Asia, the online purchasing power of the population. How it would look like in various sectors. So it's expected that 50% of all retail spending would be via online in e-commerce. Online grocery would be dominating by 2030. Transport and food, supported by e-commerce and online grocery, would be moving up. We'll be having global players coming to Southeast Asia and building their brands. Health tech would be more AI-based diagnostics, telemedicines, and remote patient care. Digital payments, 70–80% of transaction value will be fully digital. And frontier markets like Brunei, Laos, Cambodia, and Myanmar would be extending beyond what they are now. So this is how approximately a USD 1 trillion GMV under various sectors would look like in 2030. Now, with so much scope and capture needed, we have seen the evolution of super app ecosystems. So we have 2 behemoths like Grab and Gojek, who all started off with booking cars and booking motorcycles, and they moved to becoming payment giants, wallet giants, food delivery, having insurance, now having hotel and ticket booking. They are having video streaming, they have courier delivery, they are lending, they have a lending JV, and so on. And since their beginning in 2012 and 2014, they have made multiple acquisitions to consolidate all the internet economy under one app. So we'll be seeing more such things as we move forward in the next 10 years. So how has been the deal flow been? So we have seen the investments growing from $9 billion to around $12 billion in 2020. In the first half of 2021 itself, the total amount invested in Southeast Asia was equal to the total invested in 2020. There was a slight blip from 2019 to 2020 due to COVID. Globally, investments and mergers and acquisitions, deal flow and deal transactions had gone down. But now it's slowly recovering. The total valuation of the Southeast Asian tech ecosystem is more than $100 billion, with the top 10 occupying taking 50% of it. So we have Grab, Gojek, Tokopedia. Now Gojek and Tokopedia in 2021 have come together and formed a merger, GoTo. We have Ovo acquired by Grab, Bukalapak now listed, Lazada, Traveloka, Trax, and others. This is just a landscape. This is a 2021 landscape. Some of the figures may have changed, but what it's basically showing that most of the unicorns in Indonesia and Singapore. Now, recent deals in Vietnam, like Momo, has been like it's reached $2 billion with an investment from Mizuho. So this graph would get updated maybe when the new reports come in. But what we are seeing is that there's a large number of players in the $0 to $100 million. Some of them would get consolidated as we go forward, and some of them would be invested by new funds, and which will grow up from 100 to maybe a unicorn in the days ahead. But we have a large number of companies in the $250 to $1 billion zone, which shows the strength and resilience of the Southeast Asian economy and the future that we discussed about the 1 trillion GMV. Now, where has the money gone? Now, what we have seen is that the money has mainly been seed, Series A, Series B, and Series C, less in the Series D and Series E. Now, for starters, generally when you ideate a venture, you take seed money, and then when this seed money is mainly from angels and some family offices. But as you move forward into Series A, Series B, and Series C, you are maturing. And as you're maturing, you will need more funding. And various funds strategize themselves to be in each zone. Either they'll be in Series A, Series B, or Series C. And depending upon where they are, they invest. A good trend, what we have seen is that a lot of funding is happening in Series B and Series C, which is kind of a late stage funding. By the time you reach Series D and Series E, you're already profitable, or you're going for an acquisition, or you're going for an IPO. That's why you don't find a lot of venture funding in the Series D and Series E space. But the good thing about Series B and Series C is that there are a lot of late stage venture funding coming in, which are investing in Series B and Series C, allowing the companies to hold off for a longer time before they are acquired or they go IPO. Now, the sectors where most investments have happened. So as we discussed, Southeast Asian internet economy, 2021 is around 174. 2025 is $360 billion. And mostly the money is expected or to be made in e-commerce and online travel and so on. The most of the deals, $11.5 billion that have happened in e-commerce and DFS and transport and food. So these three are the top sectors where investments have happened. DFS is digital financial services. So you have e-wallets, payments, and so on. And then e-commerce. E-commerce itself is supported by transport and logistics. So in e-commerce, as we discussed, mostly it's marketplace and logistics, which have dominated the e-commerce space. We have Grab delivery and so on. And logistics catering to the e-commerce, you have J&T Express, which raised a large amount of funding recently. And yeah, so these are the places where e-commerce is taking the bet. Digital financial services are the second most after transportation / e-commerce, the second most wide after sector. So you have payments and multi-line companies taking up the major share of investments. Then you have lending, investments, small amount in remittances, and so on. So you have Endowers, Stashaway, Ajay, Bibit, VN Life, and Mint, and these kind of startups in various Southeast Asian countries, which have taken up most of the fundings in recent times. Some fintech and DFS players. So you have Gojek and OVO, mostly in Indonesia. OVO is now acquired by Grab. It's into payments. Gojek is a super app system, from transportation to payments to wealth management and so on. Then a lot of startups in targeting Gen Y and Gen Z have formed in Indonesia. Some have been acquired also. So you have in lending, payments, and so on. And then in Singapore, what we are seeing is that it will be powered by AI and blockchain. So you have in insurance, you have Singlife, then capital markets, DAQ, Crystal, Silent8, and so on. So these are some of the examples which I wanted to present of kind of startups which we are seeing in different parts of Southeast Asian region. In Vietnam, one of the largest is Momo in the payment space. As I discussed, a recent transaction has happened. Ms. Ho has invested in Momo at a 2 billion valuation. So it's a unicorn now. Old age banks are not left behind. Even they are launching new digital wallets and wealth management platforms. So you have DBS, UOB, CIMB, and so on, not getting left behind and launching their own platforms. So which are the various investors investing in fintech and DFS space? So you have seed stage to late stage. In late stage, we have KKR, Warburg Pincus, Vertex. In Series A or Series B, you have MDI Ventures, Sequoia, Excel, Finch Capital, and so on. And seed stage, you have a lot of many in the Series A, B, and seed stage. Only some have been listed here. So you have 500 startups, then a lot of family offices, cash-rich SMEs who are forming their own wealth offices, who are investing in seed stage and Series A, B. The largest funding rounds in 2018 to 20, some examples have been given, like Momo is there, VNPay, Singlife, GoBeer, Neum, which is into payments, and so on. There's a strong investment appetite from investors from outside Southeast Asia also. So apart from local players or local venture capitalist firms who are raising funds here and family offices here, there are a lot of foreign companies who are investing as part of corporate venture capital, CVCs. So you have Visa, PayPal, MasterCard, then HSBC, Credit Suisse, Aegon. These are some of the largest players we know in the world in the banking space, like Goldman Sachs, and they are coming to Southeast Asia and investing in the Southeast Asian fintech companies. So on the right-hand side, these columns are the Southeast Asian startups, and these are the large names that we hear in the Western world or in Japan and others, in China, that who have come here, like SoftBank, Tencent, Rakuten, Ant Financial, Sumitomo, and so on. So on the entry valuation, what we are seeing is that most of the transactions are being done in the pre-A or seed stage, then A and B, less on the C side. Median deal sizes are $0.8 million or less than $1 million in pre-A, and then going up in Series A and Series B to $4 million to $10 million. The entry valuation for these have been from $5 million to $55 million, are pretty decent. Though we can always debate, like for a pre-seed, pre-A kind of company, would even $5 million be a good entry valuation or not? But as we said, going by the growth and the future that we are seeing of the internet economy in Southeast Asia, nobody wants to miss the bus. So there's a large demand of investments in the pre-A zone. And my view is one of the reasons why companies are able to even get $3 to $5 million of entry valuation at seed stage or ideation stage. Now about exits. Now the most important thing in venture capital or private equity, whenever you invest as an institutional investor, you need to get an exit. The trend that we have seen, that this orange is the trade exits or M&As, have dominated the exits in Southeast Asia, followed by secondaries and then the IPOs. So you would have seen the IPO, that is this particular color, the first one, has recently started coming up. And IPO is now being followed by SPACs. So we'll discuss about the SPAC aspect also. So Southeast Asian companies or startups are being recognized globally and being accepted at New York Stock Exchange and other exchanges globally and getting good valuation. And one of the reasons why Southeast Asian companies are looking for IPO as an exit or future fundraising rather than going for Series D and Series E. On the secondary side, that is known secondary, now most of the investments or venture capital started in Southeast Asia in 2010. Most of the institutional funds have 10 years as a life of the fund. So as they would have neared 2020, the fund managers would have tried to exit their position in startups, and they would have sold their startups to other fund managers, not necessarily at losses. So there can be positive cases also. So we'll see about that in the next few slides. But the secondaries has also been an important exit arena for venture capitalists in Southeast Asia. But having said that, M&A, mergers and acquisitions, and consolidation have generally dominated our zone in Southeast Asia. Just give me a second. Pardon me, since it's stuck. Yeah. So these are some of the fintech acquisitions which have happened in Southeast Asia since 2015. So Gojek has been a prolific acquirer, acquiring around 13 to 15 small companies. Some of the deals have been listed here, like Mocha, which is into payments, $130 million. Then Grab has acquired Kudo, which is into payments and wallets. Then Gojek, Coins.ph in Philippines, payments and wallets, and so on. This is the kind of a landscape showing which year, which payment company, small company was acquired under which sector in fintech. So you have payments dominating the acquisition space, then blockchain, enterprise, insurtech, investing, lending, and then banking. So a lot of activity in the fintech space and payment space. I'm sure if you would have looked at the payments business, it's a very low margins business. And what I have seen is that it's all about customer acquisition and how much a customer likes your app and uses it constantly. And if you become popular, you become an acquisition target. I think that is what has been the general flow of business origination in this low margin space and then getting consolidated into large companies. Exits via IPO. So as we discussed, first was M&A, then was secondaries and the reason for secondaries, and now coming to IPOs, which are taking up, the interest is coming up quite in a big way. So, and if you look at the graph, the Southeast Asian IPO, like the companies going for Southeast Asian IPO is expected to go up significantly in the coming years. One of the largest in Indonesia was Bukalapak, which listed at $8 billion in August 2021. Due to market movements, now it's at $3 billion. The other one is the C, which is Shopee brand. They did an IPO in October 2017 in New York Stock Exchange. and has been one of the most valuable companies in the exchanges. It was listed at $5 billion and moved up quite a bit. And now, due to market situations, is at $72 billion. So it has actually generated a huge wealth for investors and is very popular among Southeast Asia, the Shopee brand. Then coming to the upcoming mega IPO, which is GoTo Group. So GoTo is formed last year by the merger of Gojek and Tokopedia. So they did a pre-IPO round in November 2021. They secured $1.3 billion from tech titans like Google and Tencent, Temasek, then Malaysian Sovereign Wealth Fund PNB, as well as from Abu Dhabi Investment Authority. They are expected to go for IPO this year in the first half, and the valuation expectation is around $35 to $40 billion. Then coming to the new age IPO, which a friendly app Grab went for, which is called the SPAC. So SPACs are basically special purpose acquisition vehicles, which is a shell company formed by stalwarts, by veterans who are into the industry. And based on their performance over the past years and based on their credentials, institutions and retailers invest in a shell company and provide a lump sum money to the SPAC sponsors. Then the SPAC sponsor have around 18 months to 24 months to go and find the acquisition target. Grab went for a demerger or SPAC business combination with a company called AGC, Altimeter Growth Corp, in the US. It listed at a $40 billion valuation, but now it's around $21 billion, still pretty high. If you look at the graph, the Southeast Asia focused SPACs have grown at 134% over 1 year versus only 22% for US companies. So the attraction for getting listed via SPAC is picking up in Southeast Asia. And we have multiple SPACs looking at merger options with Southeast Asian companies. Some of them are listed here, like Bridgetown and Bridgetown. It's promoted by Thiel Capital, from the famous guy, Peter Thiel. You have B Capital, you have L Catterson with $250 million SPAC. Then Patrick Grove, which is the owner of iProperty. Even they have started a SPAC, $300 million catch-up group. You have Vickers Venture, which is a prolific investor in Southeast Asia and US. They have raised $120 million. All of them are looking at partaking into the Southeast Asian growth story and combining with the new age businesses in Southeast Asia. So let's see what happens in the next few years. It'll be very interesting. And some more funds like Vertex Ventures have listed their SPACs in Singapore Stock Exchange. So even Singapore Stock Exchange is now promoting and trying to go head on head with global exchanges, where listing a SPAC and raising funds through a SPAC in a shell company is being promoted, and retail and institutions are trusting them. Now, as we discussed, whenever a venture capital invests, they want to exit within 5 to 10 years because they have a fund life generally of 10 years plus 2 years extension. Now, the average exit that we have seen for VC from startups in Southeast Asia has been around 8.3 years or 8 years. It's expected to go down to 6 years. Now, because Series C, Series B investments are happening in a large way, it's expected that the startups may remain private for a longer time because they'll have more cash coming in from these dedicated funds. So this is a year-old data of 8 years average. Expected is go down to 6 years because of acquisitions and IPO. But let's see what happens in the next few years. On the average exit valuation, yes, we have $40 billion of IPOs of Grab, expected GoTo, and Jet Express and Momo getting valued at $2.2 billion and so on. But the whole Southeast Asia system consists of many small startups also. And the average exit valuation has been less than $100 million. I think this is where work needs to be done, because we saw the entry valuation to be average $50 million for Series B. And if you're exiting from a bit mature company at less than 100, you're not making money, except for a few companies that we have seen like Grab, GoTo, and so on. So this is where I think a lot of consolidation will happen before the number moves up. And it'll be the survival of the fittest, because we are seeing many, many startups coming up trying to tap into the internet economy of Southeast Asia. So this was a bit brief overview, a top-down overview of Southeast Asia startup ecosystem. Now we will deep dive into a bit of, I'll wear the venture capital hat and try to explain you how valuation happens and how the increase in valuation happens. For some of you, it may be a known thing, but for starters, it'll be very interesting. And it's just a primer that we'll be discussing upon. And more details, of course, we discuss in the IMAA course curriculum. So before I move on to how valuation is done in a startup, I'll just give a small background about pre-money and post-money valuation. So whenever you start a company, you start with, suppose, initial shares of 100 shares. And when you go and seek investment from a venture capital or an angel investor and ask them that your money will go into the business, and you will get more shares of the business, what you are doing is you're increasing the pie. This is a pie, small pie, blue. When you issue the new shares, you increase the pie, and the total becomes this outer ring. And the new shares goes to the investor. So before investment, if your shares are 100 and the price per share, this price per share is the market value that you discuss and agree with the investor, is 10 per share. So the value of this blue would be $1,000. The investor gets 10 new shares, the orange. The value of share agreed is 10. So the value of the orange is 100. The value of the blue is $1,000. This is called pre-money. Pre-money means before you get the investment, what is the value of your shares at the price agreed and negotiated. You have agreed and negotiated, but not yet taken the money. So it's like you're going and renting out a house and you agree on the rent with the owner. Before you move in, the owner now has in his mind, this is the value of my unit. And can I go and get a better deal? So this is before you get the money, that is pre-money. And once you get the investment, it's the post-money. The other way to look at the post-money is, after the investment, what is the total number of shares? The total number of shares is 100 plus 10. So 110. The value of all the shares agreed and negotiated at the market value is 10. So the total value is 1100. So this is one way of getting the post-money valuation. The second method is you add the pre-money and the investment. The maths remains the same. You will get this value 1100 either going directly by this method or adding them. But it's very important to understand that the money which is coming from the investor is going into the business and the initial shares are remaining with the entrepreneur. Okay, so there is no dilution of the original shares, but dilution of the overall percentage of shares. This is called primary investment. The other way is secondary investment, where you sell your shares. You tell to the new investor that I'm going to sell my part of the shares. There'll be no increase in the shareholding. The pie doesn't increase, and the investor is a small part of the pie. So before investment, the value was $1,000, 100 into 10. After the investment, the number of shares still remains the same. It's only that 10 shares go to the investor. So the total value of the company remains at $1,000. and the post money will be same as pre-money. This is called secondary investment. So when we talked about secondary shares in the previous slides, remember here, secondary, this light orange. What is happening in Southeast Asia is that since 2010 to 2020, a lot of investors had shares in startups. But in 10 years, your fund is getting closed. You want the liquidation of these shares. So you're selling your shares to someone else. So the amount is not in, so the pie is not increasing. In secondary investment, the money goes to the person who sells their shares. It doesn't go into the business. Okay. So this is the difference between primary investment and secondary investment. And this is an introduction to pre-money and post-money valuation. Now we'll discuss about the most important golden question. How do you value a startup which has no revenues, no profits, it's an idea stage? Now there are many methods. The one most popular is you go to various investors and ask them, what is the value of the time and the money that you're going to invest? So suppose you go to the angel investor and ask him that, you know, I need $10 million to start my business. My pitch is this, my idea is this, and I'll be working full-time. I am the entrepreneur. I need $10 million to move from point A to point B. The angel investor will reply, whatever money you need, the fact that I'll be investing time in you, I would 30% or 33% into the business, or 1/3 of your business. Again, this is just a small example. The calculations and the numbers may vary. So I'm just using the numbers for easy interpretation and understanding. So if the angel investor says that the value of my time is 33% or 1/3 of your business, and I'm going to invest $10 million, you're investing $10 million, and the angel investor takes 33% stake. So what is the value of your business? You give 33% away. So that means the value of your business is $30 million. That's why 10 divided by 30 is 33%. So let's go back to our formula. The post money or the value of the business after the investor comes in is 30. You took $10 million. So what is the pre-money valuation? 30 minus 10, or pre-money of $20 million. Okay. So it's a back calculation. So after the angel investment round, the investor has 33% and the remaining stays with the entrepreneur. So 1 minus 33, 67% remains with the entrepreneur. 1 year later, I go for Series A. The last valuation of the company was 30. So my initial valuation will be 30. But over the 1 year, there has been certain progress into my business. Now I have a prototype. I'm selling some. People are accepting my ideas. So there has to be a premium to this 30. I, as an entrepreneur, feel that this premium should be $10 million. This could be $5 million also. And I would like to keep it on a higher side. Again, when I'm saying these things, these are all guesswork and what is accepted by the other party. So initially, when you go to venture capitalists and investors, you throw the idea that the premium that I'm going to put is $10 million because of X, Y, Z subjective reasons. There is no maths and quantitative reason around it. You can try to do it, but all are like mostly guesswork. And then you see whether it should be $10 million, $5 million, or $15 million. So your pre-money, initially was 30, you add 10. So your total becomes 30 plus 10, 40. You are raising $20 million. So your post-money becomes pre-money plus premium plus the investment raised, $60 million. A new investor comes in, Series A investor. He invests $20 million at a valuation of $60 million. How much does he get? 33%. So 33% he gets, but he will be diluting all the existing investors. Who are the existing investors? Angel investor and the entrepreneur. So the angel investor who had a 33% stake gets diluted by 33%, which is going to the new investor, which is Series A investor. So angel investor is 33%, Series A is 33%, total is 67%. How much is remaining with the entrepreneur? Sorry, 22% with the angel investor after dilution, 33 with Series A. Total is 55. Remaining with the entrepreneur is 1 minus 55. Okay. Then let's go to Series B. After 1 year, I as an entrepreneur, I'm again going and raising funds. My pre-money or the last post money was $60 million. I have again grown. I have sold more of my products. I think the premium should be $20 million. At Series B, with some substantial revenue, some good gross margin, you will be able to get this $20 million mathematically and justify it. This justification, there are many methods of doing, like price by sales, price by EBITDA, EV by EBITDA, P by E, and many methods that we have. And you may be able to justify it using DCF, but I doubt at Series B stage. But suppose we have got this number which the market accepts. Okay, I'm okay to give you $20 million to the old $60 million that you raised in Series A. How much are you raising? $20 million. So total is $100 million. 60 plus 20 plus 20. Only the new investor, Series B, is investing. He is investing $20 million at a valuation of 100. So he gets 20%. Now this 20% would dilute all the existing investors who are not participating, and they get diluted by this method. So angel investor started with 33. He is left with 17.76. Series A investor started with 33%. She will be left with 27%. And Series B investor is coming in for 20%. Total with the investor is 17 plus 26 plus 20, or 64%. Remaining is with the entrepreneur, 35%. So this is the basic flow and maths of venture capital fundraising and valuations. There can be some maths, some logic around this 20 and this premiums that we are talking about, but rest of them flow from the previous values. And this maths is higher secondary maths. Like you have to be good in your class 10 and class 11 to do this calculation. Okay. So this is like just a general overview. We'll get into more details once we'll be doing the IMAA courses. What is the other way to skin the cat? Now it's difficult for you to agree on a 30% stakes shell out on the day one of your ideation. Now there's a valuation mismatch. You feel, no, I should give only 15% of my stake or 10% of my stake. I cannot dilute at the angel stake 33%. You are the entrepreneur. So the other way of doing is a convertible financing, another way to skin the cat. What you do is you take the $1 million investment from the angel investor and promise him that whenever you raise after 2 years or within 2 years, a new institutional round, from 2021 to 2023, with the amount that you take 1 million from the angel investor, you would be able to create a sustainable business. When an institutional investor comes in and values the company, you will give shares to the angel investor at 20 to 30% discount to what investor B agrees. You don't give him shares now. You give him a certificate. And for 2 years, I will give you some interest rate also. You give me as a loan, $1 million. That interest, I will convert into extra shares. So I'll give you two things after 2 years. I'll give you shares, which will be 20 to 30% discount to what investor B values me in January 2023. Plus, I will give you interest in the form of shares as a compensation for waiting for 2 years and believing in me. Even this methodology and structure is very popular in the startup world. Then there are various PE VC terms and terminologies like participating returns, liquidation preferences, voting rights, anti-dilution, drag along, tag along, option pool, warrants, etc., etc. Some of them are listed here, like tag along and drag along. So tag along is ability to sell the shares along with founders or other investors. So if the investor has 5% shares and you as the entrepreneur are selling out, you are the maximum majority holder, but you're selling out, why will the investor remain in the company? They would like to tag along with you. Drag along is opposite. If the investor is selling out to Grab, and Grab wants majority 51%, and the investor only has 45%, they can drag you, the entrepreneur, their extra 6% to make total 51% and sell it to Grab, so that Grab gets the majority. Then you have a right of first refusal, pay to play, anti-dilution, and so on. There are many more key PE VC terms which you as an entrepreneur have to be mighty aware of before you sign the dotted lines and take the funding. Then there are different kinds of share classes also, like preferred shares, common shares. Most of the venture investors take preferred shares where liquidation preferences are there, dividends are there, participating returns are there, voting rights are there. Payment hierarchy would be higher than common shares, but lower than a general debt. So liquidation preferences would mean like kind of, if I say that I'm giving you $2 investment, I'm holding 1% shares in your company. But whenever the deal happens, whenever M&A happens, first is I have to get a 2x liquidation preference. First, I have to get $4 back. Whatever money you make, I don't care. You may make losses, but I want 2 times 2 or 2x liquidation preferences. Or in other words, you as an entrepreneur promise to an early venture capitalist that whatever is his shareholding, you will give 2 times his investment or 2 times her investment. That is called liquidation preferences. Dividends are kind of interest rates which accumulate and add up to the total liquidation preferences. Participating returns are, you will give him the shareholding. You're selling at $100 million. A venture capitalist is having 5% share. So 5% of $100 million, the person will get $5 million. Whatever is remaining for common shares, the preferred shareholders will participate in that also and take some money. So there are a lot of hidden terms and preferential terms in the term sheet, in a venture capital term sheet, which you as an entrepreneur have to be aware of. And depending upon the situation where you are, you would be able to negotiate or not negotiate those terms. So guys, these were some of the aspects which I wanted to highlight. I hope you all enjoyed. I'll now transfer this to Feryani to take it forward. Feryani?
All right, thank you so much, Rohit, for your presentation. It is really insightful. So I will take over from now. And thank you everyone for your time. And thank you, Rohit, for insightful sharing on the financial modeling and business valuation, especially in the valuation in Southeast Asia startup. So for those who are interested to learn more on how to do the finance valuations on the Southeast Asia startup companies, you are welcome to join our financial modeling and business valuations training that is going to be conducted on 7 to 10 of March from 7 to 10:15 p.m. evening Singapore time. and this is going to be conducted via Zoom. So what will be included in these trainings, right? You're going to have the Zoom access of the trainings and also the soft copies of the presentations, and also 3 months memberships to IMAA. And also you can have the access to our library, to our statistics, and also our online learning materials. And also the program fees is going to be at 2,000 Singapore dollars. And if you are Singaporean and PR, you are eligible for the financial training schemes or FTS training schemes by IBF, and it's 90% for Singaporean age 40 years old and above, and 80% for Singaporean age 39 and below. And also for the Singapore PR, you also add 80% at all ages. And these financial training schemes are eligible for those who are working in the financial institutions and also fintech. And also, if you would like to receive the information on the valuation reports and also information on the startups, there's a QR code on the right top corner. Feel free to scan and also share with us your contact details. Once I receive your contacts or email, I will be happy to send you the information over via email. And if you would like to find out more on our programs, feel free to contact me at my contact number and also my email address on the screen here. Okay. So besides valuation trainings by Rohit, we also have other trainings programs, and we offer 5 M&A certificates programs, and 2 of them are eligible for IBF standard funding training schemes, which are International Merger and Acquisitions Expert, IMAA, and also the Certified Post-Merger Integration Specialist, CPMI. So these are eligible for all Singaporean and PR working in Singapore, regardless from whichever industries you are eligible for the funding. It's the same 90% for Singaporean age 40 and above, and 80% for Singaporean age 39 and below, and also Singapore PR. And a part of it, we also offer a legal M&A, M&A acquisitions, M&A professionals, and also HR M&A specialists. And these are the other 3 M&A programs that we offered, and our trainings are conducted via virtual, which is via Zoom, like what you are having right now, and also via on-site. And also, if you are busy and you prefer to take our course with your own time, own target, and also self-directed learning, you're welcome to join our training via the online learning method, which is we are going to give you the open access to our learning materials for the duration of 12 months. Okay. And next, we also have this virtual training calendar, the upcoming one. The next one will be on the IMAA and also on the CPMI, and the date will be on the 18th to 21st of April from 9 to 6 p.m. Singapore time. Sorry. And these trainings are also conducted across the 4 days, and is also eligible for the IBF STS funding schemes. And this is going to be conducted online via Zooms. And we would like to encourage you to join our IMAA and CPMI trainings, because you will have a chance to discuss live discussions, networking, and also get to hear the insights from the trainers directly, and also hear from what the other part of the participants from the other part of the world. We also have other participants from Saudi Arabia, from European side, Australia, Japan, and China. They're also joining our virtual trainings. And last but not least, we also have the valuations training with Damodaran, who is a valuation guru, and he's also the NYU Stern professor, and he's a highly sought after expert in valuations. So we are very honored to have him to conduct training for our Asian time, which is going to be conducted virtual live in September. Please take note of the date, starting from the 19th to 22nd of September. The time-wise will be from 8 a.m. to 11:15 a.m. in the morning. All right. So the valuation with Modaran Virtual Life is very interesting. Feel free to check out from our website if you'd like to learn more on what is the difference between different types of valuations. And Professor Damodaran is going to lead you through on the latest and updates and also trends in the valuations. So this is the end of my sharing of our IMAA and also CPMI courses. They are eligible for IBF fundings. And if you have any other questions with regards to our IMAA training courses, feel free to write into us. And also I will share again my contact details. I'm located in Singapore. If you would like to have meeting or over coffee or over a phone call, feel free to contact me as well. Okay, so thank you so much everyone for your time. So maybe I will bring this cross over to Rohit, and also I'll open to Alex for the Q&A discussions.
Thank you very much, Feryani. Thank you very much, Rohit, for this very insightful presentation, especially particularly looking at the Southeast Asian market, and the ecosystem of startups in that region, I think, which was very insightful for everybody. We, of course, very open to have an open discussion with our evaluation expert, Rohit, here as well. If you have questions concerning the presentation right now, in evaluation in general, and I'm sure Rohit can help you. And of course, if you have any questions related to the IMAA Institute or our trainings and the IBF fundings, please feel free to shoot your questions now. Let's see in the Q&A field. Rohit, may I ask you something before people are thinking about their questions? What do you think, or what is your expectation? What are then going to be the future trends, especially when it comes to the evaluation part of startups and in your space as a private equity and venture capitalist?
As a venture capital, we want to pay as less as possible.
Of course.
But yeah, generally doesn't happen. Now, what we have seen is, like, when you're investing in US, Western Europe, and Southeast Asia, these three regions are very different in terms of valuation expectations. Like what we have seen is that even ideation stages at startups in Southeast Asia, the valuation can stretch to $20 million to $25 million if you have some family offices there. But that is not the case in Western Europe specifically. Like a lot of, it's well divided among cultures and languages, not well integrated in terms of venture investment and fundraising. A lot of venture funds are dedicated to specific regions, unlike Southeast Asia, where it is Southeast Asian region. So we have seen that we get very good value, entry valuation in Western Europe. Not in the US, it's always a bit higher. So we try to get $50 to $100 million entry valuation in US. Beyond $100 million, we don't touch because we need space to exit. From a venture capitalist view, it's very important then that we have to differentiate between a good investment and a good technology, because a good technology may not end up being a good investment. So a good investment happens even in a basic technology, but led by a great team. So the team becomes very important. Like if I have to place a bet on team versus technology, I'll always place a bet on the CEO. So, you know, depending upon the team and the background of the CEO, we decide what the valuation is. And frankly speaking, there's no maths on startup ideas, pre-revenue.
Okay.
It's all about like what has been the selling price of the nearest condo. I'll pay that price to my unit, you know, it doesn't matter. So there's no maths around it. All DCF, price by entry valuations, EV by EBITDA, EV by sales, all remains in the books. Yeah.
Okay, thanks.
Yeah.
Rohit, we have 3 questions here. The first question is regarding valuation for the pre-revenue startups. What are the key startup metrics would angels typically look out for?
Okay, what are the key startup? Yeah. So as I said, like now there's a difference between an angel thought process and a venture capital thought process. An angel may or may not have a specific exit period. They may come and invest because they bet on the entrepreneur, their friends, family members, and so on. And so that actually determines a lot of the exit timeline. And second is how much he trusts or he or she trusts on the entrepreneur. These are 2 major factors which drive an angel to invest in it. Now, there are a lot of angels who are quite prolific and they are into the market and they are able to compare this versus that and so on. But they form family office and form an institution. They move a bit higher because they've lost a lot of money. Once, if you're talking to a prolific angel, he has lost a lot of money to reach to the stage. So yeah, so these are 2 or 3 factors which an angel looks at. Mainly going with the entrepreneur's bet and strength of the idea.
Okay, I think we have a few more other questions, Rohit. Thank you very much for raising the first, for targeting the first question. Sean Lim has also asked about a specific slide 33, the premium of 20 million for round B. This is based on the progress of the biz or other quantitative or qualitative factors, rational correct?
So for example, like if the company has reached at a stage at Series B where the company is selling, so the company may say that, you know, measure me on the basis of EV by sales. And if I'm raising $20 million Series B, the EV by sales would be, you know, the EV or the enterprise value or the equity value will come at $100 million. So if you have the number $100 million, you are raising $20 million. Your previous round has been $60 million. So you can minus and get this answer as 20. You can go back, you know, you can get this $20 million in the other way also. So there can be some maths in Series B stage of the premium. Unfortunately, fortunately, I have seen that it's mainly like quite higher. It's more than 60. It's $100 million. 160 would be, you know, a starting pre-money. And there's no logic or basis of it. It's just a lot of quantitative analysis, qualitative analysis. Where I am investing in healthcare, there are some quantitative measures, like for example, the device should have got FDA approval or the drugs should have crossed the preclinical or phase 1 and so on. So a tangible quantitative measure would be there in various sectors in Series B. And based on that, you can decide this $20 million or $30 million. Having said that, it's, again, very difficult, very difficult. It depends upon what the other person agrees. So in venture capital, what happens is that generally you won't find one investor investing in a company. It's a group of investors. So a lead term sheet comes from, suppose, Sequoia, who's agreeable on this $20 million figure. Accel Ventures will just sign off. You have been valued at market independently by a good investor at $100 million, and this 20 comes from that. Perfect. Makes sense? Let's go ahead. So these are 2 methods in which you can get this 20.
Yes,
I hope I was able to answer.
Thank you. There's another question, which is targeting the correlation between the public and private market in terms of valuation. How do you see the liquidity affect private market valuation going into Fed rate hikes?
Well, I think if I am an investor with Fed rate hikes, if public valuation is going down, I will invest there as an angel. I'm not looking at any startups right now. Like I'm an angel investor also. it affects, like the liquidity event is very important for investors like me. So it becomes difficult because what happens is if you understand DCF, like discounted cash flow valuation, just imagine the formula of discounted cash flow valuation where the interest rate or the rate of return is on the denominator. So your valuation of today is inversely proportional to the interest rate. Okay. So of course, your valuation will be going down if Fed rate hikes happen, the interest rate hikes happen. So all the growth companies, globally listed companies, the valuations are coming down. One of the indices is ARK Invest, the ETF, which has fallen down drastically, more than 50%. So, if the listed companies growth valuation, pre-revenue, pre-profit listed companies, the valuations are going down. Of course, the private markets valuation can't demand very high valuations. So that is where this initial valuations or these premiums do get affected. And angels and family offices who have flexibility in using that $100 million or $10 million or $5 million, whether to invest in private or public, they will invest in public. S&P 500 has given a 15% to 20% return in 10 years. That's very good returns. So it becomes very difficult for private companies to raise money when such market scenarios happen.
There's another question, which I think is tough to answer, but let's give it a try. What is a reasonable pre-seed discount, if any?
So again, pre-seed discount, I'm unable to understand the question, but suppose that if I answer it this way, that what is a reasonable stake that you give to an angel investor or any investor who invests? I would go by, if I'm like, I have started a company with a friend and doing quite well now. So what we did, we skinned the cat using this method, convertible financing. We don't know how to value a company, and we didn't want to dilute a 33% stake to angel investor. So what we did was we gave a interest rate, which is the market interest rate, 2% higher than that, which a bank would give or take, and 2% higher than the market rate, and converted that interest into shares in 2 years. This dates and years are different, but I'm just giving an example. We started in 2019, so 2021 it converted. And we used this method in a pre-seed round to raise approximately $120,000 in the first 2 months of our business. We just gave interest certificates to the investors and then converted it.
Thanks. Are there any other questions from the audience which you would like to raise? We still have some time. If not, Rohit is soon going to host the valuation training, which we are specifically targeting in Southeast Asian market, and we would be really happy to see many of you people joining the training. As you have seen already, it's even funded by IBF, and where you have 4 days to really exchange ideas, thoughts, and also ask critical questions to Rohit. It's a very interactive sessions. As you can see, Rohit has a lot of experience in that field and is very happy to share it to people joining this training. I would like to thank everybody for the attendance and all the questions as well. And there's particular shout out to Rohit and my colleague Feriani. Thanks a lot for joining this presentation. And we're very much looking forward to see many of you in our upcoming trainings. Thank you very much.
Thanks.
Thank you.
Okay, thank you so much, Rohit, Alexandra, and Feriani, once again for all your sharing and the insights that you've given us. We've now come to the end of today's session. Thank you once again to everyone for joining us, and we hope you have found the session helpful. You may stay connected with us via LinkedIn, our social media platforms, or Telegram. And we hope to see you at our next session. Thanks once again to our speakers, and wish everybody a very good afternoon.
Thank you. Bye.